Happy New Year. Welcome to the flagship market observations call for the week of January the 3rd, 2023. A quick housekeeping note, no video this morning, not necessarily a bad thing. Also, just a reminder, this replay is for advisory use only. As we think about the new year, best part about it comes with a clean slate. And after last year, I think we'd all agree that's certainly a good thing. A couple quick talking points just to put the year in perspective. S&P down 19 and change. Worst year since 2008. In total, wiped out nearly $18 trillion in wealth. That was the most ever. What made last year obviously particularly difficult is double-digit losses in bonds. It was the top 5 single worst year for a 60-40 portfolio. It was also the first year in the last 50 where both stocks and bonds were down throughout the first 3 quarters of the year. Silver lining, though, when you think about the historic move higher in rates, we're now able to retire the phrase TINA. There is no alternative, with cash paying over 4% yields, obviously very attractive to owning equities. Transitory also eliminated from everyone's vocabulary. And the highlight is no one has to any longer listen to their cousin talk about crypto investing. As we flash back and quickly recap our 2022 forecast, so again, our views on markets this time last year, we had called for mid-single-digit equity returns on the back of heightened volatility. I think it's fair to say we got that forecast 50% correct. Had a strong preference for value over growth. Obviously, that did work in our favor. Large value down mid-single digits, large growth down nearly 30. Interestingly enough, favored U.S. Over non-U.S. and for everything that took place in Russia and Ukraine, developed international actually held up a few percentage points better. Emerging markets right in line with the S&P. Obviously, that was dragged lower by China, but offset by some double-digit gains in emerging commodity-producing nations. Turning to fixed income, emphasis or positioning. Beginning of the year on both floating rate and bank loans, that emphasized our views that we were comfortable with credit and expected rates to obviously rise. Each of those 2 asset classes marginally positive on the year, up a percentage point or 2 versus the ag obviously down double digits. As we think about the models, great year top to bottom. We'll include some performance figures in my note. The one piece that I do want to highlight is the excess return for each of those portfolios was generated by taking slightly less risk. Again, each of the models had a similar or lower standard deviation, and across the board, every single model outperformed on the downside, meaning it had a lower match drawdown relative to the benchmarks. Obviously, 2022, a very difficult year, but silver lining, for those of you able to go back to your clients and demonstrate we were able to better protect your capital during what was obviously a very challenging environment. The last column I want to draw your attention to, we just highlight the number of trades in each of the portfolios. And this is something including in a video we'll be putting together in the next week or so that discusses each of the strategies in a little more detail, what they are, how they work, who they're typically a fit for. But when you talk about creating a platform that has something for everybody, you see there we have the technical models, the TIMs, that are very, very tactical. Those had over 20 trades on the year. The tactical core portfolios had a dozen or so, so roughly half. And then the strategic models, all of 2 trades. So again, little something for everybody, depending upon what type of activity, as we obviously think about qualified versus non-qualified accounts, with some additional resources coming out shortly there as well. Turning to the year ahead, we are in the process of putting together our quarterly commentary that should be available next week. High-level thoughts. I think we're starting the year certainly in a much better place than where we've been for the last several months. There's obviously a lot of pessimism still priced in the markets. And as you go through the different scenarios, do think there is a case where LPL's double-digit equity return forecast could certainly come to fruition. That said, we obviously need to see a lot of progress on a lot of fronts, including geopolitical, including China coming back online, and most importantly with inflation, as that obviously then in turn dictates the Fed's terminal rate. From an investing standpoint, I think the focus will absolutely this year be on earnings. Again, profit margins still high. They've retreated a little bit, but well above historical averages. The focus, though, in all likelihood, expect slowing revenue growth. So you have slowing revenue, you have slightly reduced profit margins. What impact does that have on earnings? Currently, my view is expectations are maybe a little too optimistic. Those have to be revised lower. Then what multiple are investors willing to pay? That's how we start to frame and produce price targets from a fundamental standpoint. Shifting to bonds, expect rates to tick marginally higher. Wouldn't be surprised if we get another 25 basis points in February and March, then see the Fed pause as they observe inflation. Based on that expectation, much less worried about duration at this point, especially with ultra short paying north of 4% with virtually no credit or duration risk. That is, in my opinion, a very safe place, may be able to eke out a few extra 100 basis points in yield going a little further out on the duration spectrum. But again, still some risk there. Think ultra short, very attractive place for where we are today. The bigger concern, though, certainly credit. Spreads have not widened nearly to the degree you would expect for all of the recession talk. We're also starting to see some of those leading indicators within credit, upgrade versus downgrade ratios, coverage ratios, starting to see some of those deteriorate. Typically, you would see spreads widen in response. In this week's email, I included 2 additional resources. The first is the 2023 Outlook from Bespoke. That is a research firm, in my opinion, puts together some really good information. That is a lengthier piece for those of you that are really looking to get into the weeds, but great resource there if you have the time. Another one from one of my favorite authors is the Sevens Report. That's a daily publication they send out. The one I am including highlights the 5 key themes for next year. Again, all of those align with what I'm focused on as we think about what will drive capital markets from here. On a quick side note, if you're ever interested in subscribing to either of those, please let me know before reaching out directly to them. There is the ability to get some discounted rates. That's all for today. As always, appreciate the time. Please don't hesitate to ever reach out with any questions. If you don't connect, have a great rest of the week. Take care.